I'd like to welcome everybody. EDAC moved over here about a year ago. We like the facilities. Lets us use their rooms, and we've had 2 or 3 events here. They work quite well. I'm Bob Gardner. I'm the Executive Director of EDA Consortium. We're taping tonight's event, so you'll be able to get it online in a number of different ways. So we're joining the social media and getting our word out there.
The EDAC app on your cell phone?
The EDAC app, that's going to come. Okay, tonight, Naked and Afraid, the search for capital on Cinco de Mayo.
Where are the margaritas?
Margaritas next year. No problem, they were just towing illegally parked cars in our parking lot. Okay, back to our program. It's going to be a great night. Jim will introduce the speakers. I'd like to give you the latest EDA MSS numbers for calendar 2013. We were up fourth quarter, 1.9 million, an all-time high, and the year was 6.9 billion, also an all-time high. So EDA and IP are right at $7 billion a year. Has been growing, continues to grow. Our MSS committee collects this report. It's all backward-looking data. There's no marketing spin on it to the best of our ability. And so they're real numbers. There's lots of categories. We're very proud of that report. If you don't get the report, give me a call and we'll get you a copy of it. It's part of being a member of EDA. Emerging Companies Committee, Steve Pollock and Ed Chang. Ed Chang's on our board. He's here tonight. Ed? They manage the Emerging Companies Committees. The Emerging Company Committee is for companies 5 million and below. And this is one of their events, so we try to cater to what the needs of the smaller companies are. EDAC. EDAC, as you know, is at Moscone this year, first week of June. We got a number of events. Sunday night, starting at 5 o'clock, Gary Smith will give a forecast and an update. And at 5:30, we have a Sunday afternoon kickoff for the event. Goes till 7 o'clock. I encourage you all to come. Monday, Tuesday, Wednesday, exhibit floor is open, and the conference will go through Thursday. So it's a great event. It's at Moscone. I encourage you all to go to DAC.com and sign up for your events. Monday night, we have a special event, very, very similar to what we did in Austin last year at Austin City Limits. Jim Hogan is one of the key movers of this. We're doing this for a benefit for CASA, which is a humanity group. And we got a number of bands, a number of deals. Jim, you want to say anything?
Please come and spend a lot.
Come and spend money. That's good. Special thanks to Cadence, ChipEstimate TV, and the crew who is filming this tonight. They're going to put it up online. Great group of people to work with. They also provided all the AV for the room here. Came in earlier today and set everything up. So that's fantastic. Marketing on Demand. Jill and her team have provided all the login, all of the badges, and all the logistics and the food. Jim Hogan and crew put the panelists together. They reviewed what they're doing, and I know you'll enjoy tonight. With that, I'd like Jim to take over and introduce everybody.
Thanks, Bob. Thanks a lot. Ham, I can't help myself, so it's good. And the clicker's up here someplace, you guys? Yeah. All right, so we do these things, I don't know, a couple times a year. Today we're trying something a little different. We want to try to, we're inspired by the TED conversations. The quality might not be TED quality, right? But anyway, we're trying to do that. So I wanted to, sort of lay the foundation like Chris Anderson does for his TED Talks or the people that speak at TED, and have these two young guys with a lot of energy and a lot of knowledge about how shit works. I have no idea. And we'll see what happens, right? So let's begin. Now, I don't know if you guys seen this series, Naked and Afraid, but I'm not a big reality TV show because one of my nieces is an editor for a couple of these things. And what they do is they just keep the camera rolling. And when they're all done, they sort of chop it up and make a storyboard out of it. And then sort of have everybody fighting with each other. So they try to create that drama. Well, in Naked and Afraid, I don't think they do that. I think they just drop them. So this particular one, these guys got dropped in Africa. And they got to spend 21 days figuring out how to survive and then get to their point where they're exited, which is generally like 10 or 15 miles away in Africa, naked, right? So one of the first things they got to worry about is they got to find, food, shelter, clothing within the environment. Pretty hard to do in, sub-Saharan, Africa. There isn't any of those things. Maybe you can find a lizard you can eat or something. You got to find shelter. Turns out it does rainstorm. There's also critters that you become part of the food chain, but you're not at the top anymore. You're in the food chain below lions, for example. Drinking water. Turns out, you don't have to eat for a couple weeks, but you have to drink water every 3 or 4 days. So finding water that's not contaminated is a big deal. So the next thing they got to do is find fire. So fire is kind of the first thing humans found in this kind of environment. They adapted fire. No, we didn't invent fire. Fire was around since the beginning of the universe. But you have to find fire, figure out how to get it going. And then with that, you have security from things that might eat you. You stay warm, and maybe you can sanitize your water and eat. So what do they find out after 21 days? Well, they're a lot skinnier. If you ever look at pictures of these people, if you want to lose weight rapidly, go on this show. 3 weeks, these guys drop 35% of their body weight. It ain't water weight, There's some fat and protein coming off you. So they learn that they have to adapt to the environment and they have to rely on each other because each one of these people are survivalists, supposedly, and they come with their own set of skills and their own level of ability. So the teams that do well are the teams that work in that environment. In other words, they know how to work together and augment each other. And they recognize the team's important. The teams that don't work are the guys, and it's usually the male, starts running around doing everything, bossing the woman around, and not taking advantage of everything she knows, right? So we may be guilty of that occasionally, huh, Jan? So let's see how these things apply to our universe. All right, so you know what? This slide, sorry, I can't make a good picture out of this slide. Vishal helped me straighten it out, but it's a list, unfortunately. But, I've done pitches like this, I don't know, for 20 years, and people are always asking me, what's it take? What's it take to be successful? Well, the number one thing it takes is luck, and that's as much about timing as anything. The market conditions got to be there. There's got to be customers that need it. There has to be a market that's driving the customers, et cetera. But the number one thing is the ability of the team to adapt. There hasn't been a business plan that I've ever been involved with, invested or written myself, where I haven't had to rewrite it 3 or 4 times during the course of either making money or going broke, okay? And oh, by the way, I've done that in equal amounts, right? You go broke as often or more often as you actually make money. Cap structure. Look, man, we'll talk a lot about this today. Every time you get a VC involved, you're losing part of your company, right? Now, they're necessary. We have to use them, but you want to wait a long time before you invite them to the party. So you want to get there as far as you can, typically market validation, technology validation, before you invite VCs to come in and take 50% of your company, right? So we'll talk a lot more about that. Discrete, defendable market niche. Me and the guys were talking about this at Starbucks right before this. And, every one of us as an engineer has come up with an idea and said, great, I know a customer for that. Well, yeah, we all know 1 or 2 customers that are our buddies that will buy it. Now, is it defensible and is it scalable? That's a big problem we'll talk about today. Differential technology that has a sustainable competitive advantage. What that means is, can I trade secret it or can I put a patent on it to keep people out? Now, there's a lot of IP companies in here. Dave and I were part of an RP company called Artisan, and we made sure we patented the crap out of stuff, and we had a lot of trade secrets, and I think that helped get us a pretty good return. Adaptable business plan. There's that word, adaptable. look, man, the environment changes all the time. You got to find a way to ensure that your team can adapt to the market conditions they find. And you got to do that without burning a lot of money to find out. So I see so many startups, especially during the days when VCs were funding EDA companies a lot, is you burn through $20 million and you still don't know what technology you have or who the customer is we're selling to. And oh, by the way, by that time, 70% of the company is owned by people that aren't working there. Oh, did I forget one? Oh, quality investment group. Yeah. I don't want guys giving up. The guys I value in an investment are old school guys. They're guys that see their company and wait and, weather the storms up and downs because there's plenty of them. And don't get scared, right? So I worked for this guy named Don Lucas for a long time. Don was, chairman of Oracle, chairman of Cadence, chairman of National. I was a National guy. And Don just used to hammer on this all the time, right? What Don would always do, he would never give up. I mean, he'd be the last guy standing every time. And as a result, who's the billionaire in the crowd, right? So I don't see that a lot these days, right? I see guys that got MBAs and were investment bankers, but old school quality of group is real important. They're out there. You just got to find them. Okay, what to expect, right? Seed round, typically, you do it with your friends and family. Sometimes they talk to you on the next deal. If you made them into money, I can't talk to any of my brothers or sisters anymore, for example. But what you want to try to do is you want to establish your system architecture, your architecture of your product. You want to find a learning customer, interesting enough, that didn't put a dash in it. And what you're looking for is proof of concept in terms of the technology or technology proficiency. All right, if you get all that done, round A is about building a product. The seed round's about getting conceptual stuff done. In other words, you've interested a potential customer. Round A is about you build out the database, the UI, the things that matter to customers that allow you to scale a product. You're trying to build a product. And then you want to engage with some customers in an alpha program or a technology partner program where they will give up their time to do quality assurance on your rotten code, okay? So why they do that, who knows, but God bless them. Okay, round B, this is really where you want to stabilize the code. In other words, you're doing a demo and it doesn't go blue screen on you in the middle of it. It's actually stable, right? You find a beta customer or two. These are guys that aren't willing to be alpha customers, but beta customers that are serious about putting it in production if it works to their needs. You try to get performance and usability focused. And then if you get to C successfully, it's about you get a big support thing, you build out a big channel or bigger channel. EDA is always about building channel. Interesting enough, when you sell a company, you never get rewarded for the channel. The channel just goes away, and you spent $5 to $10 million on the channel, so you better make a lot of money to pay for that channel. And finally, IPO. And what are people looking on? Shareholder value. In fact, you go to jail if you don't. You want revenues that grow significantly, 20%. Margin growth of 20%, hard to do. Those are competing goals often enough. And then you got to figure out some new products. The trouble is I'm kind of a one idea guy, so once I do one, it's pretty hard to come up with the follow-up product. And you see a lot of tech companies, they go out, they go IPO, 6 months later they have a bad quarter, they crater, right? We see this all the time. The good ones don't. And then you got to think about global expansion because we're a global marketplace. All right. That's it for me for a bit. Vishal, handsome young man here in the front. He's a three-legged stool. He's actually pretty tall. I don't know where never mind. I won't talk about that. But he's got a really great career for a young guy. He's worked at a lot of industries. He's been a marketing guy, bottoms up, and he's working in his own practice now. And we'll talk about that a little bit when he comes up. Amit. Now there's a face that you got to kind of keep an eye on. So I'm a chairman of Amit's company, and my joke is him and Trent, the founder, they're kind of like my pet raccoons. They got opposed thumbs, and they're always getting in trouble. But that makes it kind of fun. So he's done a great job. He's had one company that he exited to Synopsys. Any Synopsys guys in the house, thank you very much. And now we're working on Slido, and Slido's doing pretty darn well. I think we sort of crossed the Rubicon of startups. We're profitable and we're in proliferation mode. So we'll hear from Amit how that childlike face can produce such great results. Okay, last sort of comment for me. Hey, this ain't over. This is just a new game, right? We just got to figure out the rules. The rules are VCs aren't going to pump a lot of money into EDA things. So you got to do it for relatively cheap and get to a point where you have customers within 3 years for very little money. That's new rules. So where's the money come from? Money comes from seed guys like Rick, yeah, there we go, Rick, and strategic investors. You know, like I got to tell you, the last few companies I've done, they've all been, you know, Intel, Qualcomm, Broadcom. These guys, Xilinx. You look to those guys because they know that the EDA part of the world, the tool part of the business, there has to be innovation and technology driven out of that. So they're going to continue to invest because they know they can't do it themselves or they won't do it themselves. So that's the way the world looks now. All right. Thanks for your attention. And I'm going to start off by asking Amit to come up. Is your mic working?
Hello?
Stick with the handheld. Yeah.
All right.
You guys happy using the handheld? Yeah, we're
Yeah.
okay.
All right. Thanks for that introduction, Jim. Okay, so I thought I'd start off. I came across this quote here that's particularly relevant for this whole idea of being able to adapt with a startup and be able to learn and grow your company. Roy Ash, what he said was, an entrepreneur tends to bite off a little more than he can chew, hoping he'll quickly learn how to chew it. So, I mean, that's, I think that epitomizes startups, and what we're trying to do is find that product market fit, get it out there, find customers for that product, and grow the company. So this is kind of the traditional funding roadmap, in the ideal world, and I'll contrast this to what I've seen in my world. But, kind of as Jim was saying, seed stage, develop your idea into that initial product, typically being able to get funding from angel investors or kind of early stage VCs, raising $500,000 to $1 million. Once you get that proven, moving to the Series A round, where you raise $1 to $2 million, you've proven the product market fit, you've generated that initial revenue. Then you get into Series B, where you've got alpha, beta, production release, raise a bit more capital, start growing your sales channel, and then IPO for a liquidity event. So that's very much kind of the waterfall ideal way of going about doing a startup. But of course, things don't really work that way. There's changes that happen both within your company and macroeconomic conditions that will affect this roadmap. Changes within your company where you're too optimistic, you think that your product is going to meet what the customer wants a lot sooner than it actually does. You realize that you're going to have to rev your product, make changes to your product. Version 1 of your product wasn't quite right. No one actually wants it. And moving it over to version 2. And then macroeconomic conditions where there's a .com bust or the housing crisis, and then nobody wants to invest. Customers don't want to buy product anymore. So this has been my fundraising experience in EDA. Very, very different than that nice waterfall. So I've raised between my two startups, I've raised $30 million in EDA over the last 12, 14 years, and from a variety of sources. So going through this, in 1999, I started my first company, Analog Design Automation, and we raised $500,000 to get started. Actually, right out of school, I graduated from engineering with my co-founders, and we started a company. This was all during the .com boom, so we just had a PowerPoint presentation, an idea for a company, and we went out, we pitched to angel VCs, and the economic conditions then, were awesome. We had a few different offers for term sheets, and we were able right off the bat to raise $500,000 from angel investors, as well as we're founded in Canada, so the Canadian government's very, very supportive of Canadian startups, and they pitched in as well. And then, so we didn't wait in that case to find that product market fit. We said, hey, the market's awesome right now. We're going to get a great valuation if we go out and raise a Series A round. So we went out to the VCs right away, and we raised $8 million in institutional and strategic investment. We got Intel to invest in that round, Synopsys to invest in that round, and we had for the $8 million we raised, we gave up, I think, 15% of the company. So they valued our company at do the math, but basically per head they were valuing our money, our company. But again, this was 2000 pre-dot-com bust. So it was just an awesome time to raise money. So what we said is, hey, if the capital is cheap, might as well raise money when you don't need the money, and we raised it. Then and then the dot-com bust happened. So then again, there was the macroeconomic conditions changed to the opposite extreme, where things were really bad. We were burning through too much capital too quickly. So we kind of hunkered down and raised $500,000 from some government sources, and then another $8 million from institutional and strategic VCs. This was a lot tougher, a lot more expensive capital. I think raising that $8 million in 2002 cost us about 40% of the company, so quite a bit more. And we were still early on the revenue side, and by 2004 we were able to prove our product, prove the customer base, and we took an acquisition from Synopsys. So in 2005 I started my second company, Solido Design Automation, and again we looked out in the market. We saw that there was interest from the VCs to invest in EDA and in my company. So rather than go the traditional seed round where we raised $500,000 or $1 million, we raised $2.5 million right off the bat from institutional investors and angel investors. Again, we gave up a small percentage of our company for that, so that allowed us to grow the company. Again, we saw excitement, so we raised another $6.5 million right away. And then so on, government funding, another $2.2 million. So I guess the overall point of this is that we raised money when we didn't need the money, and we raised more than we thought we would need, because if we needed the money, then the money would be a lot more expensive. So it's better to raise money when you don't need it and raise more than you think you need, because believe me, you'll need it. So 4 fundraising takeaways from this experience. Multiple sources of investment should be explored. So in my fundraising experience, there's a lot of different sources of investment. If you're creative, that you can leverage and take advantage of. There's obviously angel investors, and raising money from people who are familiar with your industry and your product is a good source. There's institutional venture capitalists. When approaching institutional VCs, it's important to find VCs who've invested in the space before and who are comfortable with investing with your stage of company, because there's a lot of late-stage VCs, there's mid-stage VCs, there's early-stage VCs. So find the right VCs for the right stage of fit, and people within that VC firm who's familiar with the industry that you're in. Strategic sources have been a really good source for us, in that they bring not only the venture capital, but they also have an understanding of the product and would eventually become a customer. Government sources, being Canadian, that's been a good source for us as well. There's some really advantageous things about starting companies in Canada. For example, for every dollar spent on salaries in Canada, the government will write you a check back for 70 cents on that dollar at the end of the year. So really, really good tax incentive, refundable tax incentives to start companies in Canada. Yeah, absolutely. We have Canadian institutional VCs, so BDC Capital, Golden Opportunities, and CIC Capital. Yeah. Not in Solido. In analog design, I had Intel and Synopsys. Yeah. Customers, they're great investors as well. Best investment is, of course, is revenue. The team being able to reduce the salaries, especially in the early stages with the founding team, put in some sweat equity if you believe in the product, to reduce your burn and increase your runway. Crowdfunding, that's a big thing right now. Not really applicable to EDA, but a generally interesting space. And friends and family. Fundraising should be pragmatic and opportunistic. So what I mean by that is rather than following kind of that schedule of, okay, you know, I'm at seed stage right now, so I'm only going to raise a seed stage round, and I'm at Series A right now, so I'm only going to raise a Series A round. If there's opportunity to raise money at a good valuation earlier, you should be opportunistic and pragmatic about it and raise more money than you need, because like I said, you're gonna need it when you're going to need it later on when things aren't working ideally like you originally planned. Raising money can be a negative. Could be a huge negative in that it takes a lot of time. Time away from building your business, building your company, finding your product market fit. It can also hurt your operations in that if a VC gives you $5 million, they expect you to put the money to work and burn through it in the next year or two, or else why are they giving you $5 million? So what that then forces you to do is build up a channel quickly, hire on salespeople, hire on AEs, you know, and potentially grow your company too quickly. And then you find out at the end of that, oh, you know, actually I didn't really have the product exactly right. You know, the market wasn't ready. So it's best to stay in an agile mode, I found, and work with the customer in order to figure out how to get those first sales and figure out the sales recipe on your own, and then bring on salespeople to scale it rather than scaling too early. And I think this is actually probably one of the biggest reasons for startups to fail is they raise too much funding, they scale too quickly, they expect their revenue to scale, and then at the end of a year or two, everyone's looking back and saying, "Oh, you know, why isn't my revenue where we thought it would be?" And then they have to cut back, and things don't go well from there. And then ultimately, your best investment is customer revenue. If you can keep your funding level to a minimum and just keep increasing your revenue, then that's what's going to ultimately drive your enterprise value, as enterprise value is a multiple of customer revenue. So I'll leave you with another quote from Richard Branson. Business opportunities are like buses. There's always another one coming. Thank you.
Thanks, Amit. Okay, so let's talk about what you heard, some generalized and normalized information from me. And then Amit took a specific case, his two companies, and most recently Solita, which I think he's done a good job on. Thank you very much. Appreciate that as a shareholder and investor. And so Vishal now be ready for something completely different, right? So he's got 29 slides he tells me he can do in like 7 minutes. So hold on, here it goes.
Thanks.
You got the clip? Yeah.
I do. Thanks for that introduction. Of course, there's no way but down from here. So just to give you a little bit of background, whenever I go to hear someone speak, I want to know at least a little bit of why should I hear them speak. So my background is in engineering. I've done software, I've done hardware systems, then moved into marketing when I realized, and no offense to my fellow engineers, that, oh wait, there's more of the same stuff we have to do, and that's not interesting to me, so I wanted to be out. I actually couldn't understand my first manager telling me, so this is the space you sit in. I was like, yeah, but that's in the morning. Then where do we go? I'm like, no, that's where you sit. So I realized pretty quickly that that's not what I wanted to do. And then I got into products, and I realized that I really enjoy products because you have to really think deeply about why you're building something, who's going to want it, and is it going to be more than 16 of your friends? Jim has only 2. I have 16, so I have a bigger market by myself, but still, right?
I got 4 sisters.
But they're not talking to you. But all jokes aside, right? So I've spent time in EDA, but what I'm going to talk to you about is mostly what I've done before and after. Worked in big data, networking, healthcare, genomics, just all sorts of different stuff, working for an education company right now. And that background has taught me one thing, that the lessons with startups are actually broadly applicable as a generality. And then when you get down to it, right, anything that you hear from, say, even Amit, right, when it applies to your case, you're going to have to morph yourself. So here are the different companies we worked at, everything from the Department of Energy to just raw startups. And why that's important is because, again, when you work for one company for 7 years, and then when you work with 7 companies in a year, you start to get some pretty interesting perspectives of what works and what doesn't. And so I found this app, and it does a word cloud of your website, so I did it, and I go, wow, even I don't understand that we do this stuff. So I got down to thinking, what is it that we do at Three-Legged Stool? And what we focus on is on product. We think about the product, and we think about 3 things about it. Where does it fit? In what market does it fit? What customers are going to use it? What form is that product going to take? Right? You have to know that going in. You won't believe, but half of the companies I've worked with over the last year and a half have thought they had a services product or a services offering, then try to morph it to a product, then try to morph it into a hybrid, and that just doesn't work. So you have to have clarity in how you're going to deliver that product. And then the features, which we all worry about, right? What functionality is this product going to provide? We've worked with startups, start-ins, large enterprises, incubators. And what we focus on is the early stage of the process. So before product launch, our thesis is that that's where you can impact 95% of the product. So that's where you should focus. That's where we focus. Okay, so I think you've heard enough about me. So let's talk about you, right? So you're a startup founder in some form. You are thinking about, you're an entrepreneur and you're thinking about a new company. And what you have to realize is that when you're out to raise money, when you're looking to create enterprise value, and this is across the segments, again, that we worked at, right? People are looking for a repeatable and scalable model. Even within services, that's what they're looking for. Because while you'll get your first 3-4 customers, they're planning to give you money for your 20 and 100 customers, and you've got to think about that in mind. And trust me, my partner's done a startup as well, and that's not how you naturally think because you just want to get focused and do that. But you have to take advice of your investors, folks like Jim that I constantly talk to stay at the big picture. Because if you're not doing that, you're going to go meet a VC, and they really are the superheroes of the modern world, right? Because what they've done, if they've convinced all entrepreneurs that a major part of your success is not the product, not the customer, but getting money from them. And that's incredible, right? Because you came up with everything, and they're going to give you money to take a part of what you've built. And of course, it's not going to be a fair share, right? Because they're in the mode of making a multiple bets and getting a 10x return. So they're getting something highly disproportional. And for that money, what they're going to ask you is 3 questions. What are you going to build? Why are you building? And how do I believe that you're going to build it? So I came across the slide. I searched Google. I couldn't find what the heck it was. And I learned this because I went with a company that I was consulting for, pitching to VCs, right? And we knew the product cold, and we're walking in there, and we're saying, so it's really obvious, right? This is what we're doing. This is what we're doing. 40 minutes into an hour session, 3 partners all look at us and say, Vishal, let me stop you for a minute. What is it that you guys do? So you could get so involved deep down into your features and technology that you're not stopping to think, why should they care? And why should the customers care, right? Because you assume that they get it. And trust me, they don't, particularly the VCs. And that's not their fault. They're money guys, right? They just want to hear, how are you going to tell them the story? Do they believe that story? And so the very first thing that I recommend to startups is if you're going and pitching something, start with a demo. Keep it terse, keep it to about 2-3 minutes, and tell them, this is what we do. If you can't do a demo, just show them a 30-second explanation video. And I like the videos even better because I've used that. When they're watching the video, right, you should be listening for what they're asking and watching their body language. Because when you do that, you're going to learn the tempo of the meeting. I bet if you ask Amit, and when he's gone and pitched to VCs, he'll tell you, no meeting was exactly like the same. The fact that he had over-prepared is what made him successful in those meetings, because you don't know what you're going to be asked. Okay, so the next thing they're going to ask you is, why are you doing this? Why are you even trying to do this? And the first thing you have to think about is there a market? So there's a lot of us who want to do new things, and we really, really believe that we can create markets. And I'm here to tell you that in 99% of the case, you don't create markets, you serve them. So know your market. Think about things that go into a market. Where's the gap? How am I going to get to the market? In this market, that's shelf space. In our market, it's the channel. Think about how you're going to get to that. Because if you don't have a way to get to your customer in a scalable way, you're not going to be able to sell your product. Then there's this term that's very, very hip outside of our EDA world, right? It's minimum viable product. And at least the way I understand it is that it's not really a minimum viable product. It's just getting to that demo, because the minimum viable product is nowhere close to what you're actually going to go out with. So keep that in mind, because VCs will tell you, where is your MVP? And particularly those who are outside of EDA. They're just trying to get a sense for, do you know how to go through this process? They're not judging you on, is that your final product? So we hear a lot about differentiation, right? And I think that people love to talk about differentiation, but guess what? A pink iPhone is different from the other iPhones, but that doesn't sell, right? So it's not just differentiation. It is easy to be different. It's much difficult to be better, right? So you've got to figure out, how are they doing this today? And how am I going to get them to do it better? And if you can convince the VCs that you can actually do it better, then they're going to look at you. And it doesn't matter how bizarre the idea is, because there are people who've pitched hovercrafts in San Francisco, right? So clearly your idea is not ridiculous. Trust me, it isn't, right? But go in and have that conviction, because when they're talking to you, what they want from you is a business plan that actually focuses on this part. If it works, I'll get money. If it doesn't, what do I do? Because one thing that you know for a fact as you're going through this is that when they're going to give you the money, they're looking for, are you anticipating that there are changes ahead? Because there are going to be changes. And how are you going to address those changes? So there are two things about adaptability that are very interesting, right? One is you should be able to do whatever is required to move forward. But you cannot do that. You absolutely cannot do that unless you have some basic principles. The ones that I look for is have great clarity on what your product does. It is extremely tempting with VCs and your first customer to say, yes, it can do that, and do that, and do that as well. And I'll tell you, if you're doing that with a VC, they're just going, oh, this is a bad idea, because these guys don't know what they really want. You have to be capital efficient. I mean, this just goes without saying. If you go outside, again, our industries, the number of people who will talk about capital light models, right? Because now they know that with 55 people, you can get WhatsApp to get you 19 billion. In fact, the worst thing that I've heard is that 19 billion is the new billion. And I don't even know what to do that, because I can't even count to billion. But that aside, right, you have to have capital efficiency and then have clear customer focus. Because the thing you learn most about your product the first time you take it out is that it's not even half the product that's actually going to get you to your exit, whatever your exit is. The final thing I'll leave you with is team. This is one thing that VCs won't tell you up front, but having spent time with them, you'll realize that they are really looking to see if your team has all the elements that are required, right? So a basic team should at least have someone who can develop the product, sell it, and market it. And if you don't have those elements of the team, or you don't know where they're going to come from, that's going to be a negative mark against you. And of course, they're going to look to see if it's a strong team or not. Because in the end, I'll leave you with this quote, right? That it's not about strength. It is indeed about adaptability. Thank you.
Thanks a lot. So, Darwin, right? Is everything Darwinian, right? So, you know, the other way to say this is that you got to respond to change, and that means the climate, business climate in our case, right? So yeah, it isn't the guy that's the strongest or the smartest. It's the guy that adapts the best. So that's kind of the overall theme. It's not only the person, back to naked and afraid in Africa. You have to adapt to the environment. Secondly, if you try to do it by yourself, you end up looking like him. But you know, but if you got another person, it scales your capacity, right? So team is everything, right? All right. So those are the big ideas that we had to talk about today. Now I'm going to ask these guys a few questions. And I hope I don't bore you with the questions too much, but I would also encourage you to ask any question yourself. Like, Scott, your question was great. I would have loved to talk about it. Jim already has a question. No, it's okay. So I don't need to start these guys off, because if the floor has questions, we'll just go there, and then we won't burn up all our time listening to me. Go ahead, Jim.
Okay. I'll just make a point. First, I think all the principles that all of you described are spot on for people who've done startups. And it's interesting when you read stuff beyond EDA, so and so raised 100 million, 200 million, and I think to your first point is that I'd like to see a headline slide. How little did you raise? How little did you raise? Could you raise less? And and of course the whole point of that is if you raise less, you have more for yourself. That's the whole point of a startup is how much you're going to have when you finally acquired or go IPO. And the second point I was going to make is, I think all the points about customers are good. I'd add one thing: the quality of the customer is crucial, because your sales cost per revenue dollar is going to be the metric that's going to allow you to look profitable, extend your business at a low cost. And of course, the first sale to a Qualcomm, Broadcom, blah, blah, it's going to be expensive, but that's going to be dramatically lower with each successive sale as they spread, proliferate throughout the company. So those are the 2 points I want to make.
Okay, thanks, Jim. In fact, I'll tee off that a little bit. I'll start with Ahmet, and I'll give you the mic. Or maybe I won't give you the mic, and I'll just answer it myself. But yeah, that's a good question, my young friend. How did you manage to proliferate your stuff?
Yeah, I mean it's a good point, right? Because for the Qualcomms, Broadcoms of the world, they're good teacher customers in that the features that they want aren't specific to them, right? As opposed to a company like Intel, for example, where you're doing a lot, probably more custom development to integrate with their simulator or their PDKs or their environment. Qualcomm, Broadcom, a lot more. The features that you develop for them, you can roll out to other customers a lot more easily. So, in our model, I think what we've seen is that having large early teacher customers to develop out the next version of our software and then roll that and then use that as a scaling mechanism to other customers, saying that these big customers are using it, you guys should too. I think that's really helped as part of our proliferation process.
Great. I mean, there's a sort of a theme here that actually I talked about it. Lynn Vishal talked about it a little bit too. People are more alike than different. You want to talk about that?
Sure. So, I talked about a few of the companies a few of the segments and the companies that I've worked with recently. And I think the alike point, right, and I'll take a little bit of a contrarian view on, what you said, if I could, right, what you said about using as little money, right, trying to bootstrap it as much. I think the important thing is that when you actually talk to people, right, you have to understand their motivations. And I always start by asking the client, right, what is your end goal? Because if your end goal might be, and I've seen everything from education companies where they're like, you know what, I don't need to go make millions of dollars. I want to make sure this gets out to millions of people. And I'm not suggesting that you don't make money, but I think that the common theme that you're seeing, that I'm certainly seeing, is that piece around capital efficiency. I think people have become more and more aware. So you might end up taking the $8 million that Ahmed did, right? But how you use that $8 million, the capital value over time is really important, right? The downside is that the pressure you get from the VCs to spend that money. But I'm seeing actually that pressure go down. So I'd certainly say one thing, that people are being more capital efficient, and they are recognizing that value of that money over time will allow you to make those pivots and adaptations. The second thing that I see in common is people certainly have a customer focus, but I will say that more often than not, what I've seen is their reaction is still, oh my gosh, somebody called me, let me see how high I can jump. So to your point on quality customers, right, that's a really hard thing to do, when you're naked and afraid, right, and you don't know where the water's going to come from. And I think that's what's going to separate the people. I'd say those are two of the biggest things that I see that are common.
And if I'm supposed to be the moderator, but let me talk. Oh, Scott, go ahead.
I was just going to say, on that same theme, the word that hasn't been brought up really in terms of the capital is survival.
Yeah.
Just being able to survive through the time period, because everything takes longer than you expect, right? And Ahmet, you've gone through this twice. Maybe you could add your own experiences to this.
Well, Scott, I'll start and then hand it to him if you don't mind. And so, this is across a bunch of companies. Honestly, I don't know how many companies I've done, but it's like a lot, right? And so what the model, if you can get there in 3 years, get to a point where you can get yourself to break even, that's the ideal thing, right? Paul was with a company that we did that with called Altos, and real capital efficient company. So the challenge was when we started that company, we were in static timing. Over the course of talking to customers, realized there was a characterization opportunity. Switched company to a characterization company. Everybody told me there's no market for characterization. But interesting enough, a lot of customers paid us for it. And so I think survival is everything. Now, when Jim and Ken and Kevin started that company, they weren't just in a small building. They were in a building, and they were in the closet of somebody's building, right? So I had to go through 5 cubes to get to those guys. They didn't take any money for 2 years. Not everybody can do that. But it took them 2 years to discover the market, right? So Ahmed's got a similar story. Here you go, buddy.
Yeah, I mean, I think for me, it's you can't force it, right? So you've got a product, you've got a market. You can't, and a lot of people think this way, where okay, you got your product, hire a team of salespeople, 2 AEs per salespeople, give them a $2 million quota, go, right? And then you find that your expense rate goes up dramatically, right? And then it's like, oh, why isn't our product selling as quickly as we thought it did? So you can't really force it. You have to figure out that sales recipe early on, quickly. And if it's going to take you a year, it's going to take a year. If it's going to take you 2 years, it'll take you 2 years. But you have to, as a founder, you have to be the person who's doing the adaptation. You have to be learning from the customer and pivoting as the founder, as opposed to having the kind of the levels of disconnect between you and the customer, where you have the salesperson or the AE talking to the customer, the salesperson talking to the customer, and then you talking to the salesperson, getting all that filtering, and then you're unable to generate that sales recipe. So that's point one. The point two is when there's like catastrophic events that happen, like the recent recession, you have to cut deep quickly. And so what a lot of companies did, right, is they did a lot of layoffs, but they did it quickly to cut their burn, because they realized that revenue is going to come in a lot more slowly than they originally anticipated. And you have to realize that I've got this much money in the bank, and I'm going to have to make it last this much longer. So the worst thing you can do is not make those big decisions quickly in order to survive, to your point.
Yeah. By the way, I just want to emphasize your point number one. I think more companies have probably failed because they get the product ready and the board says, go. Yeah. Hire a VP of sales, hire the sales team, go, build up revenue, and of course you build up a pipeline, but the product might not quite be ready, the message might not quite be right. For whatever reason, things don't close as fast as you want, and you burn through your whole round or whatever.
Yeah, I mean, and you got to look at their model, right? They want to see you get to a break-even point at 3 years, a little more than 3 years, and then turn the corner and start generating revenue and profits, right? So what you find, I think what a lot of us have found in this room, is that it takes longer than 3 years, right? I was talking to George, and George was saying his average is sort of 6 years. Mine's 8. If you look at everything I've ever done, it takes about 8 years to kind of get to a point where you got a good growth rate, say 25%, and you're kicking off a couple $1 million a year. It took me 8 years. And then companies get bought after that, right? Other companies get sold before that, but they get sold for asset value. So, oh, yeah.
One really quick point there. I think the VCs get it more now, though, than they did several years ago. There's 4 Steps to Epiphany, I forget the author, in Lean Startup. But this whole idea of pivoting and agility, VCs really get that now. So I think that's less of a problem in the need to scale quickly than it was several years ago.
I just want to underscore a point that Amit was saying, right? So VCs actually are not pushing you to hire the sales team, right? They're pushing you towards revenue. And if you push back and you say, sales guys, which are one degree of separation removed from the founder, they're not the tool you want to use for product market fit. And if you're doing that, then the chances that you're going to get to the product that you really believe is going to fit, it just tanks. And you have to keep that in mind. And I guarantee you, if you push back on a VC, right, they'll accept that. Now, you have to have confidence that you're doing it not because you're searching for it, but because you really need the time to do it.
Yeah, I think in general that's what I found too, is that, specific example, Solido, but often the case, is VCs, they want to see revenue faster, right? They only have one thing to use, give you more money, and for giving you more money, they take more of the company. You, on the other hand, you want to see revenue too, but you don't want to spend a lot of dollars on AEs and guys in the channel till the product is ready. So if I look at almost every company I've ever been involved with, the product wasn't ready. When everybody thought it was ready, you go test the market, you find out the stuff doesn't work, you spend 6 months to a year trying to make it work for the market, and in so doing, you burn another year's worth of dough, that's a couple $1 million, and you're out of your $8 million in 2 years, right? And then you're at the mercy of the people that will give you financing at that point, and God help you. Okay, I just want to be sure that I'm catching people in the audience if they have any comments or questions. Otherwise, I'll keep on going. Okay, thanks, Scott, for the question. Well, did I take the mic away from you? Oh, okay, good. Yeah. Gee, I love hearing myself talk. And in preparation for this, we sat around and talked about things, and one of the things that we came to was, look, how can we get to that validation point faster? How do we find that customer acceptance of what we have in mind for a product faster? So I'll hand it to you guys.
So I mean, I think the thing there is, Steve Blank talks about this really well. It's keeping your team really small, tight, your founder, your software developers, working directly with those end customers, iterating with them, and I'm probably less concerned about building a product for 100 customers as you guys are. If you can get it right with those first 2 customers and develop a product that they want, and then you start expanding onto that original product idea to service customers beyond that, and then you bring on the sales channel after that to start scaling it. That's the right way. Like I was saying before, having like a VP of sales and sales team and AEs as the interface and a buffer and a filter between you and the customer, I mean, that just kills you. Yeah, exactly.
What was the question again?
How do you get to validation?
So I think that there isn't really a trick to it, right? I think if you look at it from a market perspective, not marketing, but market's perspective, right? Again, back to your quality customers, right? Quality customers, for most people as customers, will give you more money, right? But know this for a fact, right, that they're going to make you pivot. So while in EDA, if you go get a Qualcomm and an Intel, you're all set. In most other segments, that doesn't necessarily work, right? So you certainly have to have a great conviction about what your product is. Then the moment you step out and you get to your first customer to talk about it, you've got to drop pride, not conviction, right? Because what I've certainly found working with startups is that listen very carefully, because the one thing that you've probably not thought about is the use model. And I don't mean the UI, and I don't mean any of that. I mean, how are they going to use the product? Because you have only provided one view of that, right, which is the view that your company knows. Once you go out and you're open to that, you'll find that pivoting, that getting to the right fit will happen faster. That's your validation phase, and that's probably the best way you can do it. The other rule that I have is, if you're talking to 10 really important customers all the time, then you're not focused. And I've seen this just across the board proven, right? Because what you're doing now is you're not adapting, you're reacting to their wants and desires, not even their needs. And you've got to be careful about that. So maybe the punchline there is, right, feel confident in saying no. I've done that in large companies, I've done that in startups. Just say, from a business perspective, I just can't afford to spend that much time. And trust me, more often than not, they'll respect you for it.
I had an interesting conversation this morning. In my life, what happens is I often get calls like from private equity outfits and investment bankers that are thinking about buying who knows what, right? And so this one investment banker or private equity guy, he's looking at the AT test business, right? So he's looking at companies that Danaher owns, which are Keithley, Fluke, and Tektronix. He says, "What do you think?" And I said, look, man, it looks like the NI, National Instruments, has gone to virtual instrumentation. Agilent's gone to virtual instrumentation. MathWorks, for example, has got the Simulink product that does all this stuff. I said, you're just not going to sell that many logic analyzers or oscilloscopes anymore because, they got it, all they need, so the best you have is a replacement market. He says, well, the largest customer for these guys is Intel. And I said, Intel's definitely guys that worry a lot about validation and spend a lot of quality time. A little side, then I'll come back and hand it to you guys. So one of our companies, Grant and I were sitting in a boardroom. One of our directors is a big-time Taiwanese semiconductor guy, and he's talking about shopping silicon. So he can get a pretty high capability TV controller for about $20, good die from TSMC. The same good die costs about $145 from Intel Foundry. So if you look at Intel's costs, equipment, people, materials, it's probably actually less than TSMC. So what is the issue, right? So Intel's carrying around a lot of overhead that does some design for a processor group and a bunch of packaging and things like that no one else carries. So being a foundry guy is very difficult. So the point of the story is, and you kind of got at it, is are you talking to the right customer? Okay. I think you've talked to the wrong customer.
I mean, just to kind of carry that thread a little bit is kind of the other idea for talking to the right people or the wrong people is failing fast, and that's not being stuck on your ideas originally, but being able to, when you go in and you're talking to customers and you're pitching X and they say, well, I love X, but really I want Y, not being married to those ideas, being able to fail from that idea and then move over to the new ideas. That's kind of another thing that we've learned over the years. I mean, I can't think of a startup that I've done where the original thesis of the company was what ended up making us the most money. And in analog design automation, we had this idea for analog circuit synthesis where we would create structures from scratch based on hardware description language. And, we'd pitch this to customers and go out to customers and they said, well, that's nice, but all we really want is some optimization. And I think there for us as EDA people and engineers, it's not necessarily the most technically interesting and challenging algorithmic things that customers want and will pay money for, and that's important for us to recognize is that if it's something that's really simple that they want and they'll pay for it, that's something that we'll go after. But I know, a lot of people they want to just kind of do the hardest problems and the most algorithmically difficult ones when it's sometimes the simplest things that will generate the money.
I think it should be clear from my presentation, right, that I definitely think that simplicity is important. I think that, I couldn't underscore enough the point of this is not to tell your friends from engineering school that you've created the best algorithm for the 19th time in a 20-year span, right? This is about being able to sell something. And I say this in all seriousness, right? I tell my clients the very first thing. I have 2 engineering degrees, no business degrees. So I understand all the biases. But you have to recognize, right, that you have to get past that bias. The other thing about the getting to product validation, right, is remember that when you're going through this experience, right, you should have conviction about the market. And if I led you to believe that I meant conviction about the features, it's not about the features, it's about the market. And as you talk to customers, you're going to learn better and better about the market. And what Amit's example was classic, right, because he learned that it was the right segment that had the problem. It was the wrong problem that you were addressing. And because he talked to end customers about that, he was able to make that pivot. Because if he hadn't and had been, hard-nosed about it, there wouldn't be any company to talk about.
Yeah, thanks, guys. Any questions from the audience? Yes, sir.
I don't know whose slide is this, Darwin's slide?
It's Vishal's.
So I want to ask you who you think is the strongest species among in EDA or whatever, which will not necessarily survive, and not necessarily the most intelligent, which will not survive, but which one is the most opportunistic and responsive to changes, which will outlast all of them?
So I thought it was Grant who was going to stump me, but I guess you are. So I'll start by saying that I'm neither the strongest nor the most intelligent, so chances are my answer is not going to be good one. So I'm going to hand it over to Jim with that humility.
You know, the thing about Darwinism, right? 4.5 billion years of life on the planet. For about, the first 1.5 billion years, we were algae, right? So most of the DNA that exists in us is, multicell algae, right? So this is the DNA we have to work with, right? That's what brought us here today, right? So to your question, who's the smartest? Well, who's the strongest? Well, Synopsys has got the best balance sheet, without question, right? So they've done a great job of taking advantage of the downturns to buy companies relatively inexpensive, have a wealth of technology, okay? They've went into IP early. They've bought a bunch of IP that really makes them a formal customer to talk to if you're selling just EDA or just selling IP, right? And then they did something really interesting recently. This is where the intelligence part comes. They bought Coverity. Now, Coverity, is above the drivers. It's up around, does an application work on the operating system, right? The thing that's closest to SoC is the drivers, right? They went beyond that. They spent a pretty good premium for that. So we'll find out if they're the smartest. That's the question. But the beauty of it is they had the guts to go try. They used a lot of that cash they had, and they went off and tried to break out of where they are. So in the end, that's, certainly in human history, it was the guys that left Africa, for example, that brought us here. Who the hell thought it was going to be greener in Saudi Arabia at that point, right? But somebody had the faith or the vision to move. And so I commend them for that, right? So other guys, certainly Mentor buying BDA recently, that's a bold step for them. I think that'll yield some pretty good results. And Cadence taking Jasper in under its wing. That was a big move, right? They paid pretty good premium for that, 5.2x, right? So those are bold moves. I'm really happy to see them buying companies and taking risks. So if you go back to 2008, nobody was doing anything. So it gives me hope, right? It doesn't take much to give me hope. But, it gives me hope because if people are starting to pay a premium, that we're starting to see some results of our work and our investment, and investors are making money. More importantly, common are making money. So we're talking, Altos guys are sitting at 3 years now at Cadence, right? It's about time to start reharvesting that bunch, I think, and for the fourth time. And so, it's great because once somebody has some money in their pocket, they're willing to take a chance again, and that's what's happening again, and I'm very thankful for that. Was there another question? You guys ready for drinks? Okay, let me do this. I thank you for your attention. Appreciate you guys hanging out for us for a little over an hour. Hopefully you found this, somewhat interesting and entertaining, I hope at the very least. And I commend EDAC, thank you, Bob, for hosting this event and feeding us. That probably cost more money than we ever thought it could. More importantly, they brought the alcohol. That's still in the back. So I want to thank you for coming to one of these things and listen to us for an hour. Let's go have a drink.